Close your eyes for a second and picture this: the world's strongest economy, the safest currency on Earth, the place everyone runs to when things go wrong. Now imagine that system quietly cracking, not with a crash, not with a headline, but with small sounds most people are ignoring. Because that's what's happening to the U.S. economy right now. Not collapsing, not exploding, cracking. And cracks are dangerous because you don't notice them until the structure fails. Here's the uncomfortable truth most people don't want to hear. The U.S. economy isn't in trouble because of one big mistake. It's in trouble because of a long chain of temporary solutions that never ended. And today, the math is catching up. This matters right now because the U.S. economy isn't just America's problem. It's the engine of global trade, the anchor of global finance, the reference point for every other economy. When the U.S. sneezes, the world catches a cold. When the U.S. cracks, the world feels it everywhere. Let's slow this down and strip away the noise. For decades, the story of America was simple. Work hard, produce more, grow faster than everyone else. After World War II, the U.S. didn't just rebuild, it dominated. It had factories when others had ruins. It had consumers when others had ration cards. It had dollars when others had debts. The dollar became the world's money not because it was perfect, but because everything else was broken. And that created a powerful loop. The world needed dollars, the U.S. printed dollars, the world bought U.S. assets. America grew even more. For a long time, that loop worked. But then something subtle changed. America stopped growing mainly by making things and started growing by borrowing. At first, it didn't look dangerous. Borrowing feels harmless when interest rates are low. Debt feels invisible when asset prices are rising. Problems feel far away when the future looks infinite. The U.S. government borrowed, corporations borrowed, households borrowed. And every time the system slowed down, the same fix was used. Lower interest rates, more spending, more liquidity. It worked in 2001, it worked in 2008, it worked again in 2020. So people assumed it would always work. That assumption is now the crack. Because debt doesn't disappear, it only moves forward in time. Let's talk about the uncomfortable math. U.S. government debt is now over $34 trillion. That number is so large it doesn't even sound real anymore. So, let's translate it into something that hurts. Every year, the U.S. has to pay interest on that debt. Not the debt itself, just the interest. When interest rates were near zero, this wasn't a problem. Paying interest was cheap, almost painless. But interest rates are no longer near zero. They're high, and they might stay high. That means interest payments are exploding. Soon, the U.S. will spend more on interest than on national defense, more than on education, more than on infrastructure, just to service past borrowing. That's not investment, that's maintenance. And here's the quiet irony. The U.S. can print money, but it cannot print credibility. If investors start doubting whether U.S. debt is truly risk-free, the entire system shakes. Now zoom out. The U.S. economy today runs on three pillars: consumer spending, government spending, and asset prices. Consumer spending is about 70% of GDP, but consumers are stretched. Credit card debt is at record highs. Savings rates are low. Wages haven't kept up with inflation. People aren't spending because they're confident, they're spending because they're surviving. Government spending is propping things up, but government spending is funded by borrowing, which means tomorrow is paying for today. And asset prices, stocks, real estate, bonds, these prices stayed high because money was cheap. Cheap money inflated everything. When money stops being cheap, gravity returns. That's where cracks start to form. Now let's talk about inflation. Inflation wasn't just bad luck. It wasn't just supply chains. It wasn't just wars. It was the delayed bill for years of excess liquidity. When trillions of dollars are created faster than real goods and services, prices rise. That's not ideology, that's arithmetic. The Federal Reserve responded by raising interest rates aggressively. Necessary? Probably. Painful? Absolutely. Higher rates slow inflation, but they also slow everything else. Housing freezes, business investment drops, debt becomes expensive, defaults increase. The U.S. economy is now walking a tightrope. Lower rates too early, inflation returns. Keep rates high too long, growth breaks. There is no painless path. Now let's talk about something rarely explained clearly. The U.S. doesn't just borrow from itself, it borrows from the world. China, Japan, pension funds, central banks. For decades, foreign investors bought U.S. debt because it was safe, liquid, and stable. But now the picture is changing. China is reducing exposure. Some countries are diversifying reserves. Others are questioning dollar dominance, not abandoning it, questioning it. And questioning is enough to raise borrowing costs. Here's the irony. The U.S. benefits from being the global reserve currency, but that privilege encourages overspending because there's always someone willing to buy U.S. debt until there isn't. Now let's bring this back to real life. Why does this matter to you? Because cracks don't announce themselves. They show up as small problems. Higher rent, more expensive loans, fewer job openings, market volatility that feels random. It's not random, it's pressure leaking out. Corporate America feels it too. Many companies survived on cheap debt, zombie firms that couldn't exist in a normal rate environment. Now refinancing costs more, margins shrink, layoffs follow, not all at once, slowly, quietly. The labor market still looks strong on the surface, but cracks are forming underneath. Multiple jobs, gig work replacing stability, wage growth slowing. Employment often breaks last, not first.
Now zoom out even further. The U.S. economy doesn't operate in isolation. Global supply chains are fragmenting. Geopolitics is reshaping trade. Energy transitions are expensive. Defense spending is rising. All of this costs money, and money is no longer free. Here's the absurd part. Everyone knows this system is strained, but no one wants to be the first to accept the pain. Politicians want growth without sacrifice. Markets want returns without risk. Consumers want stability without slowdown. That combination doesn't exist. So the system stretches, and stretched systems crack. Not because people are stupid, but because incentives reward delay. Fixing the problem now hurts. Delaying it feels easier, until it isn't. Let's talk about hype versus reality. The hype says the U.S. economy is resilient, and in some ways it is. Innovation is real. Productivity hasn't vanished. The U.S. still attracts capital. But resilience is not invincibility. Reality says growth is increasingly artificial, driven by deficits, supported by debt, stabilized by policy intervention. That works until confidence erodes, and confidence is fragile. One bad auction, one policy mistake, one geopolitical shock, cracks widen. Now here's the uncomfortable question nobody likes to ask. What happens if the U.S. has to choose between inflation and stability, between higher prices and slower growth, between protecting debt holders and protecting consumers? There is no option that keeps everyone happy. That's why this moment matters, not because the U.S. economy is collapsing tomorrow, but because the margin for error is shrinking. Small mistakes now have big consequences, and the world is watching. Because when the center of the system weakens, alternatives start to look attractive. Not perfect, not ready, but tempting. History doesn't repeat loudly, it shifts quietly. The cracks don't mean the end of the U.S. economy, but they do mean the end of easy answers. The era of print, spend, repeat is fading. The bill is due, and it doesn't care about politics or optimism. So here's the final thought. If the strongest economy in the world is struggling to balance growth, debt, inflation, and credibility, what does that say about the rest of the system built on top of it? And more importantly, when the cracks become visible to everyone, will it already be too late to fix them?